when the markets seem to be getting a little bit out of control with so much uncertainty and the downtrends we've seen recently. It's always good, for me anyway, to look at things and keep them in perspective, to keep some bit of sanity while the market works through these times of uncertainty. Yesterday was a pretty big day in the market. The Dow for the second day in a row was down 5.5%. S&P gap down 5.97%. The Nasdaq was down nearly 6%, and the VIX jumped 50% yesterday. If we look at it sector by sector, consumer discretionary was at the top, I think, because of some agreement on the tariffs that gave some of those discretionary stocks a little bit of a bounce, even though it still was down 4.31%. Then the next three sectors are considered primarily defensive, and even though they're defensive in nature, they were all down between 4 and almost 6%. And energy was at the bottom of the list with the 9.2% drawdown yesterday. So if we take a look at the SPX that I've been tracking, looking at various target levels just to get some idea of where the market could be going, I use the anchored VWAP to establish some of these levels. Yesterday I was asked, how do I determine what my anchor points are? And basically, if we look at these, it's really significant lows in the SPX. So those are why those particular dates are selected. But if we look at the S&P, what it did yesterday, it's gapped down 2 days in a row. So we're down currently about 17.42% from the last closing high on February the 19th. The 50-day is on the decline. The 20-day is on the decline. The 200-day moving average, this red line right here, is still on the rise, I believe. Let me take a look. Nope, it's actually decreasing now, so that's not a terribly good sign. But anyway, these VWAPs are tied to these specific dates. These are all decreasing at the moment. Some of these just rolled over in the last couple of days. This first anchor point, you can see that we've tested that 1, 2, and then 3 times, actually broke through it pretty significantly here. This one has just been tested a couple of times, and then we broke through to the downside. Then the January 4th, 2024, that's been tested 2 or 3 times. Yep, 1, 2, 3, actually 4 times. And then it's broke through and got to this next level. And then broke through pretty significantly. We even bypassed the August 6th of last year's low, which was a pretty significant point in the market with the yen carry trade. So we've broken down support through there as well. And then this next level, the 49.15, is actually a 20% drawdown from the most recent high. So if we do reach here and break down through that, we'll actually be in a bear market at that point. So right now we're still in a correction phase, but we're making our way to that bear market possibly. The one thing that I see with the MACD is we're in the lower portion of the MACD chart. We did get a negative crossover yesterday, so that means we have a sell signal. And the encouraging news here is the RSI is sitting below 30. We're actually at 23.25. So that indicates a pretty extreme level of being oversold for the S&P. Yesterday, the trading volume, I think I mentioned yesterday, this is only 6% above. That's obviously incorrect. It was about 50% above the 50-day average on trading volume. And today we're actually sitting at 79% above this 50-day moving average. And we did mention the VIX yesterday. It had risen to 30 yesterday, and today it jumped up 50% to close the day at 41.35, which is actually the high of the day. So that leaves a little bit of uncertainty on what could happen on Monday. If we look at the implied move, I didn't really cover this yesterday except to mention it. But if we go down to the options chain and we look at the 17th, which is on a Thursday because Friday of that week is a holiday, so the U.S. markets will be closed. But if we scroll down to the current level of the S&P, you get down here to where it crosses over. There we go. We can get this midpoint here for the put option, the midpoint here for the calls. Just add those two together and divide it by this level, gives you the implied volatility. Yesterday we were sitting a little bit above 4%, and after the trading yesterday it jumped pretty significantly to 7.07%.